right, welcome to the last Taxes in Retirement Live of 2020. Yes, I have can you see this in the picture here, little reindeer hat going on to celebrate the holidays, celebrate the end of the year, celebrate, thankfully, this year is almost over. So yeah, this is the last Taxes in Retirement of 2020. We'll be taking a 2-week break, and then we'll be back January 6th with the new and improved version of Taxes in Retirement Live. Same me, same corny dad jokes. There will not be reindeer headgear next year, but I'm going to be using a different software, third-party software, to improve the quality and the presentation and the functionality of these live streams. Not only will it make it, I'll be able to screen share, but it'll be easier to have guests on, and I'll be able to post up people's questions as they come in. I can post them on the screen so you all see them, who they're from and what the question is. So looking forward to that. Again, January 6th, I will be back. This is the last Taxes Retirement of the year. With that said, I thought it was appropriate to do something that is timely for those of you who are interested or have questions about or considering doing Roth conversions. You got to get them in soon. I'll say it a few times throughout this video, throughout this live stream, but figure you have to get it in within the next week. At least with clients I work with, assets are custodied at TD Ameritrade Institutional. TD has said you have to get the conversion in by December 21st in order for them to be able to guarantee they'll process it this calendar year, before the end of 2020. If you get the request in after December 21st, it's best efforts basis. So they can't promise you'll get it in this year. So anyway, I wanted to do this today for those of you that are trying to jam in a conversion before the end of the year. I just want to make sure you all know, or at least have a decent idea of what a conversion is, what to consider, when it may or may not make sense. This video is not advice. Speaking of, this video is only general, can you see this? General explanations and education. It's not specific tax, legal, investment advice. Before considering acting on anything you see or hear here, first consult with your tax, legal, or investment advisor. Especially important today. Again, I am not giving any of you specific advice about whether you should or shouldn't do conversions or how much or when. I'm just giving you general guidance and education of things to consider. Work with your respective professional or on your own if you're comfortable doing it with figuring out how and when and how much to convert. All right, dad jokes. Christmas themed, and I'd like to send a special shout out to my daughter Darcy, my 11-year-old daughter, who helped me find these jokes. I asked her to do something productive with her phone instead of TikTok, and find me some end of year or holiday or Christmas themed dad jokes. Had to go through about a dozen of them to find ones that were keeper enough, but here's what we got. Why did Santa's helpers feel sad? He had low elf-esteem. It's like self-esteem, but without the S. What does a gingerbread man use to keep his bed warm? A cookie sheet, of course. Pull it up, keep it warm. Which is ironic, because cookie sheets are also what they use to bake and melt themselves. And finally, how does Santa keep track of all the fireplaces he's visited? He keeps a log. Of course, he keeps a log from the fireplaces. All right, good. So let's start. And just to preface, let me drop a comment in here quickly that you all can see. So I did a video on my YouTube channel in May, actually, called What You Need to Know About Roth Conversions. I just plopped a link here, so you all should be able to see that. Consider that sort of like the companion to this. This is sort of the off the cuff. I have some talking points here, but otherwise this will be live sort of Q&A, just discussing things, whereas that video is very scripted and there's some slides in there and whatever. So everything I'm touching on today is addressed in that video. So for those of you who haven't seen it yet, there's the link to it. There's also a whole boatload of other good stuff on that, on my YouTube channel. Retirement Planning Demystified is what it's called. You can just go to that video and that I sent the link to and find it from there. But all kinds of stuff, lots of things we talk about in this group, and even some other things. That YouTube channel isn't just sort of tax focused, whereas this group historically is. As you can tell now, I'm kind of branching out into other broader general retirement planning questions and content. But nonetheless, the point of that YouTube channel is it's a broader array of retirement planning topics. So tonight, all about Roth conversions. Hold on, Cannon's saying, I'm disappointed. I thought you were going to do the show from your back patio in shorts and a t-shirt. I got a t-shirt at least. Given the warm weather that you have in New Jersey. Got to gloat for a few months. I've been in Florida, et cetera, et cetera. Yeah, so those of you who saw my post the other day, we are in the middle of a nor'easter. It hasn't gotten too bad yet, but there is 5-6 inches of snow and some fairly stiff winds. So if for whatever reason power goes out, this live stream's getting nipped right there, unfortunately. So let's hope for the best and hope we don't lose power or internet. But if we do, you'll know why if I cut out all of a sudden. So Roth conversions. Let me just start super high level. What is a Roth? I mean, I assume most of you probably know this, but just in case, a Roth account is a type of account where the money you put in is after tax, meaning you don't get any sort of contribution for it. But the upside is that the growth along the way is not taxed. And then when you eventually take money out, assuming you meet a few qualifying criteria, there's no tax on the money that comes out. Now that's a whole separate topic, those qualifying criteria. I have a couple YouTube videos on that, but just assume you hold it long enough and you're at least 59 and a half, all the money comes out of your Roth tax-free. So you can have potentially decades of growth, all of which will be not taxed along the way, and then come out tax-free. That's the big benefit of Roth accounts. You can have an IRA flavor, individual retirement account. So anyone who has earned income can open up an IRA or a Roth IRA. Or if you work for an employer that has an employer-sponsored retirement plan like a 401k, 403b, or the federal TSP or thrift savings plan, they may have, the federal TSP definitely does, your 401k or 403b may have a Roth option as well. It all depends on how your employer chose to set that plan up. Maybe you do, maybe you don't. But nonetheless, Roth is just a type of account. It's not just an IRA. It's not just a 401k. Roth just means the taxability of the account. Taxed on the money that goes in, but then not taxed when the money comes out, which is the exact opposite of traditional tax-deferred accounts like regular IRAs, regular 401ks, where the benefit of those is you get a tax savings on the money you put in because you can deduct your contribution, but you're not actually getting rid of tax. You're just simply deferring it to be dealt with later. And we'll discuss tonight why that's potentially a problem. Sounds good, and they get you up front because you save some money, but you end up paying for it down the road. So why use a Roth? Obviously because you're not taxed when the money comes out. Again, that's the trade-off. Tax-deferred account, you save money now, but you're taxed later. A Roth is the opposite. Pay tax now, but you're not taxed later when you take the money out. So the basic approach, and if you go to calculators and things online, they're just going to steer you towards what do you estimate your income is now, what do you estimate your income will be in the future. It'll just apply tax rates what we know they are today and what they can't really assume, but they'll tell you what they think tax rates will be in a few years because we know they're going to go up, and I'll touch on that in 2026. But they'll just basically do a quick, are you in a higher tax bracket now or will you be in the future? That doesn't tell the whole picture. So yes, obviously money that comes out of a Roth is tax-free, which is good. But the other thing to keep in mind with tax-deferred accounts, when you pull them out, not only is that money taxable in the future, but it could trigger off other taxes or have other impacts. So for example, the amount you pay for Medicare is based on the amount of your gross income. Withdrawals from IRAs count in that gross income. So you may now not only have to pay tax in the future on your IRA withdrawals, your regular tax-deferred withdrawals, but it may kick you into higher brackets such that you have to pay more for Medicare. Another real big one, if you're on Affordable Care Act insurance and you have any sort of subsidy called Aca Premium Tax Credits, the amount of credits you're eligible to get are a function of your income, your gross income. The lower the income, the higher the credit, and at some level of income, you phase out from getting any of these credits/subsidies altogether. If you are getting credits, it could potentially be thousands of dollars a year. I talked with someone today who's currently getting $23,000 a year for a household of 3 in these premium tax credits. And there was a post in the group the other day about someone in Pennsylvania who's getting, I think it was like $2,200 a month in potential, or $2,300 a month in tax credits. That's big money. When you get to the point where you're pulling out money from an IRA, again, it's taxable, regular income tax, but it could also make you lose these potentially thousands of dollars a year in tax credits because all of your IRA withdrawals will jack up your gross income. So that's another downside to having tax-deferred money that you just kick in this tax can down the road. Also, more of your Social Security may be taxed based on the amount of gross income you have, because Social Security is not an all or none taxation, it's a sliding scale. The more gross income you have, the more of your Social Security gets taxed. And then another one to consider, Not hugely important unless you have hundreds of thousands of dollars of income a year, but there's something called the net investment income tax, which is if you're married and your gross income's over 250, or single and it's over 200, there's an additional 3.8% tax on all of your passive investment income, dividends, interest, capital gains, rental income, things like that. So tax deferred withdrawals count into that $200,000 or $250,000 gross income threshold, where if you go above it, boom, there's an additional 3.8% on all of your passive income, passive investment income. So that's why it's potentially problematic to have to just defer all your taxes down the road and deal with them later, because when you pull it out, regular income tax, and again, you may lose ACA credits. You may have to pay more for Medicare. More of your Social Security may get taxed. You may bump yourself into this higher net investment income tax bracket where you have this extra 3.8% on your passive investment income. That's the downside of tax deferral. Plus, who knows what the future is going to hold, where taxes are going or whatever. So anyway, so that's why you would use a Roth, is to try to bite the bullet, pay the tax now, and save yourself all this potential tax and headache down the road when these Roth withdrawals come out tax-free. They don't increase your gross income, so they don't trigger off these Medicare surcharges that I mentioned. They don't count against you for these ACA premiums, things like that. All right, let me just take a quick look here, see a few comments popped up. All right, David Foltz, do you think there's an ideal tax diversification percentage among Roth, traditional, and brokerage? Great question. Hold that thought. At the end, I have 3 questions that I get routinely that I'm going to address about Roths and Roth conversions, and that's one of them. David, good question. David Myers talking about state taxes. Yeah, and that's one thing a lot of us often overlook. It's easy to talk about the federal taxes, federal tax brackets, and they are more important in most cases because federal taxes in absolute terms are larger than state taxes, but don't forget state taxes, right? Especially if you live in a state that has income tax. Some states you don't, and it doesn't really matter. But like New Jersey, where I live, for example, not only are tax deferred withdrawals, like traditional IRA withdrawals, that's not a great example because they exclude some retirement income for retirees. But other states, let's say, you make tax deferred withdrawals, it counts as income on your state income tax return, just like it does federal. And on your state return, it may also negate you from being able to get other possible credits. Like in New Jersey, there's property tax rebates. New Jersey's got hellaciously high property taxes. The worst, if not, second, if not the worst in the country. There's a property tax rebate based on how low your income is. If you're below a certain threshold, you get this rebate. If your income's over that threshold, you lose that rebate. So like IRA withdrawals could possibly put you over that threshold and then make you lose that rebate. So not only are you in a higher state tax bracket to start with, but you potentially lose, a couple $1,000 maybe of rebate you would have otherwise gotten. So another thing to keep in mind, another sort of stealth tax that comes into play with tax deferred withdrawals, at the state level at least. All right, so Jackie just saying $6,000 a year tax credit for ACA. Yep, so that that's good money right there. That's not something you want to try to lose. All right, Chris Foltz, is it possible to pull money from a traditional 401k while working and convert it to a Roth IRA? I'll jump ahead a little bit. Maybe. So most employers don't allow what's called the in-service withdrawal, meaning while you're still employed there, you can't take money out of your 401 and move it to an IRA or whatever. But some employers allow in-service rollovers where you can say, hey, take some amount of money from my traditional 401k, roll it into my Roth 401k. If they allow that, great, then that's an option, but not everyone does. And they most likely won't allow you to roll it outside of your 401k into a Roth IRA, Chris. But the proper answer is check with your employer, see what they do and don't allow, because every plan can be slightly different. All right, and yeah, Dave Myers, in California, state income tax easily reaches 10% or more. Yep, true. California is not kind when it comes to income taxes. All right. One more question before I march on here. Shauna Clay, what benefits are there if you choose not to do Roth conversions and let the RMD withdrawal be what it is? Yeah, that's a good one. So what benefits are, well, the benefits are less hassle. You're not worrying about it. not that people necessarily, not everyone worries about this stuff. Some people do, but not everyone worries about it. Also, estate planning purposes, if you do have legacy goals of leaving your money to someone or a charity, perhaps, like if the majority of your wealth is going to a charity, for example, and the majority of your wealth is in regular tax deferred accounts, that's ideal, because charities don't pay tax. So you can leave tax deferred money to a charity. You never pay the tax because you just kept deferring it, kicking it down the road. And when you die and leave that money to a charity, they don't pay the tax either. The only one who loses out is the IRS, and it's completely legit. Or if you're leaving it to a relative or family or friend or whatever who's in a really low tax bracket, doesn't have a lot of money, then leaving that person tax deferred money could be pretty good because they'll be in a relatively low tax bracket. So when they do take the money out, they're not going to pay, hopefully won't pay huge taxes on it. So those are the upsides. Again, just the other upside is not having to worry about it. If you're someone that has $4 or $5 million bucks and live a fairly modest lifestyle, even if all your money is in tax deferred accounts, so what? Maybe you don't care. You're not going to run out of money, most likely. And the tax savings you can get is just going to further make your portfolio that much bigger over the decades. And do you really care, right? If your goal is just to spend it and there's not a lot of chance you're running out, maybe do nothing. You don't have to worry yourself with these with not converting or with converting. Yeah, no simple answer. And that'll be a theme throughout tonight. There's no single universal answer. There's no right answer per se. It's all facts and circumstances. A lot of it's going to come down to personal opinion, how much you feel or think taxes will go up in the future, how comfortable you are potentially writing a large tax check today to do a conversion. In the last 2 days, I wrote hefty checks, one to the Iras, one to New Jersey, for large conversion I did this year. And it wasn't a comfortable feeling. Well, I didn't write checks. I mean, I did online ACH, but didn't feel good. But, I know it's the right thing to do. And the future me will be very happy. But still, it was a tough pill to swallow to just see that much money leave the checking account just to go to pay taxes. But it's for the good. It's for the better. All right, let me chug on a little bit here. I see there's more questions, but all right, some of these will be addressed as we roll on. So when to consider a Roth, and this isn't just conversions yet. I'm just talking about Roths in general, but when to consider using a Roth or putting money into a Roth, I should say. Just look at my notes here. So, kind of two broad answers to that. One is if tax rates are lower than they likely will be, is one time to consider when to put money into a Roth or do Roth conversions. The other one, which could be in conjunction with the low tax rate thing, is if your income for the year is lower than you anticipate it will be going forward. So it could be because you just retired, and that's often the ideal time to consider Roth conversions. Your wages stopped, so your wages went away. You may not have started Social Security yet. You may not have started a pension if you even have one. You're younger than 72, let's say, so you don't have to worry about the required minimum distributions from your tax-deferred accounts. In theory, you have zero taxable income for the year. Maybe you have some bank interest or capital gains or whatever, but that aside, you have super small amounts of taxable income. Those are the good years to consider do conversions, because you can fill up, depending whether you're single, married, whatever, 50, 100, 150,000 or more if you want to go nuts with this stuff of conversions and have it all only be at 10 or 12 or maybe the 22% tax bracket. That's sort of the sweet spot in terms of low income. But you don't have to be retired to do that. You can also, maybe you're switching jobs or you're taking a sabbatical or something, and your wages or earned income are lower than they were and lower than they will be going forward. Like me, for example, the reason why I did such a large conversion is up until last year, I worked full-time elsewhere and thankfully made pretty good wages. Last November is when I started this planning business here that you see, and my income went to zero, from pretty high to zero. So this year I don't have much income, taxable income to report, especially I made some money in my business, but then have a decent amount of expenses against it. So my wife makes pretty good money, but my personal income is negligible this year. So this is probably the lowest earning year my wife and I collectively will have for maybe the rest of our lives, up until retirement, but for the rest of our working lives, this may be it. So, that's why I got in a big conversion, had to write that big fat check today or yesterday, which wasn't pleasant. But anyway, so that's when you want to consider getting money into Roths, when you have unusually low years of income or tax rates are really low. So what do we know now? Tax rates are generationally, federal tax rates at least, are generationally low due to the Tax Cuts and Jobs Act. Tax rates dropped in 2018 and they're due to stay there until 2025. So starting 2026, federal tax rates are due to go up at least 2 to 3% across the board, across all the brackets. Maybe things will change sooner, maybe they won't. Tax legislation is always subject to change. If politicians want to change it, they can, if they all agree on it. I don't think there'll be massive changes in the next few years, but who knows? I also can't say with certainty that the Tax Cuts and Jobs Act will actually ride itself out until 2026. Things may get changed sooner. But for the time being, at least, until 2026, we are in the lowest federal tax rates any of us are likely to see in our lives. So that's one objective reason to support considering doing Roth conversions or Roth contributions now over the next handful of years. So that low tax rates, that's the one. And as I mentioned before, when your income's low, early retirement, that's sort of the sweet spot or tax planning window, especially for people, for retirement planning, where you're typically late 50s, early 60s, if and when you hit that spot where you stop working, don't yet start pensions or Social Securities. You got a great handful of years of really low income that you can take advantage of to fill it up with conversions or something like that. One other thing to consider, sort of separate from low tax rates and low income year, is if you are going to convert, it would be ideal to do it when stock market's really beaten up, like it was in March when things were down 20, 30%. Why do I say that? So if you're going to convert, let's say your goal is to convert $100,000 for the year. All else equal, you would rather convert that same $100,000 when stock prices are really depressed, because you'll buy at the dip, you'll get a lot more shares, a lot more bang for your buck with that $100,000, so that when the shares eventually rebound, whether it's a month or whether it's a year or two, when it eventually rebounds, all that rebound is now going to be in the tax-free Roth world, as opposed to if you just let the money stay where it was in your regular IRA, let's say, all that rebound, I mean, it's good that it rebounds, but all that gain is going to be eventually taxable when you pull it out. So it's impossible to time the markets, but if you can, if you're going to do a conversion and you do it when the stock markets are really dropped, whether 10, 20, 30% down or whatever, that's the ideal time to do it. For a given dollar amount of conversion, you get much more conversion bang for your buck when stock prices are really low. So I know a lot of people I've anecdotally heard, did conversions in March and April. Great for you. That was a perfect time in this calendar year, at least. That was a perfect time to get conversions in if you were lucky enough or had the foresight enough to sort of hit the market when it was at its bottom, or just dumb luck enough to hit the market at its bottom. All right, so that's when I consider doing Roths. And finally, how do you get money into a Roth? I kind of touched on this already, but there's really two ways: directly contribute or convert. So how do you contribute? You can either open up a Roth IRA, you can put in $6,000 this year or $7,000 if you're 50 or older, but that's subject to income phase outs. For like a married couple, for example, once you hit $206,000 of gross income, you're phased out. You can't directly contribute to a Roth at that point. If you have a 401k, 403b, or the federal TSP, and those have a Roth option, you can contribute there. And those limits are even higher. So this year it was $19,500 is what you can contribute, or if you're 50 or older, an additional $6,500. So that's that's $26,000 you can get into a Roth if you have a Roth IRA, Roth 401k, 403b, or you work for the federal government. So that's another way to contribute with no income limits. You can be earning $2 million a year in wages from your employer. If it's a 401k, 403b, TSP, you can still put in that $19,500 or 26 grand. It's not like a Roth IRA where you get capped out once your income's over a certain level. So that's how you can contribute. There's another way called the back door. I'll have separate videos on that. I won't open up that can of worms tonight. But third way, that's not really a third way, but rollover. So like if you have, you already have money in a Roth 401k, for example, and you leave that employer, you can roll over that Roth 401k into a Roth IRA. Now, I'm not considering that because you already got money into a Roth. You're just moving it from one Roth account to another. It's not like a contribution or a conversion, which is where you first put the money into your Roth. So rollover doesn't really count. For those of you who are thinking, well, why isn't a rollover considered the third way to get money in? Because the money's already there. You're just shifting it from one type of Roth account to another. All right, before I talk about conversions now, let's next main topic. Let's see what other comments here. Cody Garrett. Lori, do you want to address the qualified charitable distribution of the RMD? Wasn't going to, but sure. So if you have a tax-deferred IRA, regular IRA, and you're 70 and a half or older, you can do what's called a qualified charitable distribution, which is where you send money directly from your IRA to a qualified charity. You can do, I think it's $100,000 per year per person as of now that way. So if you're charitably inclined and you have an IRA and you're 70 and a half or older, all of your cash giving should be done through a qualified charitable distribution. Again, you have to send it direct from the IRA to the charity. You can't take the money out and then write a check. That kind of defeats the purpose. So let me leave it there, Lori. But yes, great comment. Qualified charitable distribution. Nothing to do with Roth conversions, but that is a good way to get money out of an IRA if you're charitably inclined and over 70 and a half. All right. Doug, timing is everything. Converted 85,000 on March 20th. Awesome. Yeah, March 23rd was the bottom, at least in US. I think that was the S&P bottom. Yeah, so you nailed it right on, Doug. That's the way to do it. Now, if you would have converted that same $85,000 today, you would have gotten much less buying power, much less shares, and you wouldn't have gotten that big run up in growth in your tax-free Roth world. All right. I'm just looking at other comments here. Eric's really kicking himself for not converting at the end of March. Yeah, hindsight's always 20/20. Don't beat yourself up about it. It's like stock picking. It's like timing the markets in general. It's easy to say after the fact, oh, I wish I would have did that. I wish I would have bought Tesla at $100. Whatever. And I'm not promoting Tesla. I'm just saying that's a freak example, and it's a hot topic. Lots of people talking about it. It's easy to say after the fact what you could have, would have, should have done, but more difficult, while it's happening. It's impossible to say, yep, this is the bottom, I'm going to do it. So, all right. Robin, self-employed, semi-retired, does it make sense to contribute to a SEP and traditional IRA to reduce taxable income so my Roth conversion is done at a low bracket, or is it defeating the purpose? Let me think about that. Yeah, could work, Robin. So the deduction you'd get on your traditional contributions would reduce your income. Your Roth is then gonna bring it up. Your Roth conversion will bring it up. If you have the money to, that much money that you can put some into your tax deferred accounts and still do conversion and pay taxes on it, sure, it could work. Doesn't necessarily defeat the purpose, but yeah, you're just reducing your gross income with one and increasing it with the other. All right. Wow, lots of comments. Jeez, I'm not going to be able to keep up with these. Ted Reyes, unrelated to tonight, but quick and easy. Do long-term capital gains count for income for ACA, Medicare, tax, and Social Security? Yes, it does, Ted. The gross amount of it counts for all three of those things. All right. Sorry, I don't want to just sit here and have you all watch me read questions, so I'm just trying to skim these real quickly. I may be missing some stuff, but... All right, let me keep, wow, good Lord, a lot of stuff. Let me keep going on through my comments here. I should address, presumably, a lot of these questions. If not, it'll be a free-for-all of questions at the end. So what is a conversion? Conversion is simply where you have money in a tax-deferred account. It's never been taxed, and you choose to, I don't want to say roll it, you choose to transfer it into a Roth. Now, you're taking something that's never been taxed and putting it into something that needs to be taxed prior to the money going in. So that means that the amount of the conversion will be taxable to you in the year of the conversion. So you will have to pay tax on it. Now there's an exception. If you put in after-tax money and roll it, that's different, but I don't want to muddy tonight's discussion with that. That's a whole other topic that we've discussed before. That's called the backdoor contribution. So anyway, so you have like $100 in a traditional IRA has never been taxed. You say, hey, I want to convert this to my Roth. You call up your custodian, say convert it. They move $100 from your traditional IRA to your Roth IRA. Boom, just like that, you have $100 in your Roth IRA. Well, guess what? You have to pay tax this year or in the year of the conversion on that $100. So plan accordingly, okay? So that's a conversion. There's no limit on how much you can convert or who can convert. Doesn't matter how old or young you are. Doesn't matter if you have zero income or lots of income. Anyone is able to convert. Keep in mind, like I said, you'll have to pay taxes on it. So all else equal, if you're already in a high tax bracket because you're earning a lot, high wages, or you sold a rental property, you got a big one-time gain from it or something, those are high income years. Probably not the best years to convert to add further taxable income on top of it. So just keep that in mind. There's no limits on how much you can convert, but you're gonna have to pay tax. So be aware of that. The process is relatively simple, especially if you're converting from both accounts with the same custodian. So like an IRA at Fidelity, your IRAs at Fidelity and your Roth IRAs at Fidelity. Simple. I'm not promoting Fidelity, whatever. Fill in the blanks. Fidelity, Vanguard, Schwab, TD. It's all the same thing. It's usually a simple form. You just say convert from account A to account B. You can say convert X amount of dollars of cash. You can say convert these specific securities. You can say convert the whole thing, whatever. Fill it out, give it to your custodian. They do it all typically within a day. That's fairly simple process. If you're converting from an IRA at Schwab to a Roth IRA at TD, that's going to be a little more cumbersome. I would say just open up the Roth IRA at Schwab in the first place. Do it all under the same custodial umbrella. Not to say it can't be done, but it's more hassle and a lot less direct. It's not worth the effort, not worth the potential headaches, in my opinion. There's no harm in having multiple accounts somewhere. You can have 5 different Roth IRAs at 5 different custodians. Most custodians, there's no cost to open it, no cost to maintain it. So, double check that before you do, but I think that's typically the case. So it's easiest just to have your IRA and your Roth IRA at the same custodian. And if you're at an employer that has like a traditional 401 and a Roth, and they allow in-plan conversions, super simple then. Just call them up, figure out what the process is. It's usually a few button clicks or a simple form, and they can convert like that. Now, I mentioned before, I'll say it again, the end of the year is fast approaching. Custodians get super, super busy the last week or two of the year because everyone's trying to jam in end of year tax planning moves and conversions and whatnot before December 31st hits. So you're running out of time for this year. Like I said, I work with TD for my clients. TD has said, if you don't get us your conversion instructions by December 21st, we cannot guarantee we'll get them done this year. If you do get them in before the 21st, they said, yes, we will do it. Outside of that, it's best efforts basis. So they probably will, especially if you get it in 22nd, 23rd, whatever, but do not wait till the last week of the year. If you do, you should plan on it not actually getting converted this year. Now, maybe they could, but don't be surprised if they don't. So my advice is definitely do not wait until the last week of the year to try to do a conversion, because it may not happen. They may do it and bump into next year perhaps, which could possibly be ugly, especially if you're going to have lots of income next year. So call up your custodian, find out what their timeline is, what their deadline is to get it in, but don't wait till the 28th, 29th, 30th of December to try to do this. Okay. What to look out for, did I say that right? What to pay attention to when doing conversions. Like I said, it's taxable income in the year you do it, whether you do it January 1st or December 31st. You have to pay tax on it, in that tax year. So make sure you have the money to pay the tax. Don't do a $500,000 conversion and then be like, oops, tax return time comes and you owe, $150,000 in taxes you don't have. That would be bad, obviously. So make sure you have the taxes to pay. How to pay tax. This is a whole separate rabbit hole. We've addressed this in other videos, but you can either increase your tax withholdings from sources that have tax withholdings, like your wages, jack up your tax withholding on your wages. Or if you have pension or Social Security, you can increase tax withholding there, or you can make estimated payments. Now, estimated payments, it's a little tricky with the timing. Basically, if you want to be safe, you can, in the quarter that you do the conversion, that's when you should ideally pay the taxes on that conversion, or the taxes attributable to that conversion. Don't do a large conversion in January. and then wait until December to do one big fat estimated tax payment, you may get hit with underpayment penalty because you're supposed to pay the tax as you go, as the income is earned or realized. So keep that in mind with taxes. Also, I touched on this before, but don't overdo it with conversions. Because again, not only is it taxable income and will increase your tax rate and the amount of tax owed, obviously, but it could trigger off other things you may not be aware of, like bump you into those, if you're of Medicare age or actually 63 or older, it could bump you into other thresholds where you have to start paying more for Medicare. It can make you lose these Affordable Care Act tax credits, which, as I mentioned, could be thousands of dollars a year. That's not money you want to give up, probably. It could pull more of your Social Security taxation, and it could also, potentially put you over that net investment income tax threshold of 200 if you're single, 250 if you're married, where you're going to have an additional 3.8% tax on your passive investment income, like dividends, interest, capital gains, rental income. Roth conversions cannot be undone. They used to be able to up until a few years ago. That was taken away. So, for example, a few years back, you used to be able to, in January, just sort of guesstimate what your income is going to be for the year and say, all right, I'll do a $100,000 conversion now. Why not? I'll overdo it. And then as the year progresses and you get towards the end of the year and you know with certainty what your income is going to be, because the whole year, will have passed at that point, then you can say, 100 is too much. I only want to do 80. So you can undo 20 grand of that conversion. Well, you can't do that anymore. They took that away. The Iras, the government, whatever, took it away a few years ago. Once you do a conversion and your custodian hits submit and processes it, that's done. You can't be like, oops, let me do that over. No. So think twice, or not think twice, but do your math and your analysis and income and tax projections carefully before you pull the trigger on doing a conversion, because it's irrevocable. Once you do it, you can't take it back, unfortunately. Be aware of withdrawal rules. Now, this gets real squirrely. I have other videos on this about Roth IRA withdrawal rules. When you do a conversion, if you're under 59 and a half, at least, you generally can't take out the amount that you converted without it sitting and baking for 5 years after the year of that conversion. Let me try to say that again. So I'm only 43. If I do a $100,000 Roth conversion today and I pay tax on it this year in 2020, I can't take out that $100,000 from my Roth IRA until until 2025. If I do, there's going to be a 10% penalty on me taking out any part of that $100,000 that I converted this year. So that each conversion has a 5-year clock from the year of that conversion, or really all conversions done in a given year have a 5-year clock that you can't take it out. Now, once you're 59 and a half, that 10% penalty goes away. Let me leave it at that, because I literally, did a whole hour-long live on Roth IRA withdrawal rules, and that's a dangerous rabbit hole to go down. But just something else to keep in mind if you're converting. Don't plan on taking the money out within 5 years. Unless you're over 59 and a half, then that 10% penalty goes away, like I said. But if you're younger, each year of conversions has a 5-year clock where you can't take out that converted money without a 10% penalty. All right. Good. Wow, lots of questions. Let me skim through these here. And apologies if other people have already answered these down the chain. I'm just kind of starting at the top and scrolling down. Brenda asks, so Roth conversions are not a transfer in kind event? They can be, Brenda. When you convert from your IRA to your Roth, or your 401k to your Roth 401k, you can usually select convert X amount of cash or convert whatever securities. You name the ticker, you name the number of shares, etc., and they'll convert that. Now, just be careful. If you're really trying to nail your conversion down to the penny, when you select securities to transfer, you don't necessarily know what day they're going to transfer them. The way these in-kind conversions work is that the day they transfer the securities over, the value of that conversion is the closing price of those shares on that day. So for example, let's say today, Brenda, you fill out a form to say transfer 30 shares of XYZ. And based on today's price, you think that's going to be a $30,000 conversion. But maybe your custodian's delayed. They don't actually process your conversion until 2 days from now. And in that time, the stock had a big rally. So in 2 days, when they eventually transfer those shares, maybe the value of the conversion is going to be like $35,000. So that may be more money having gotten converted than you were planning on, which may or may not be a problem, but nonetheless, it could be more than you were expecting. So that's the thing to watch out for when you're doing in-kind transfers or in-kind conversion of securities, Brenda. All right. And we should. Won't conversion involve selling also? So sell market low? No. I guess sort of just indirectly answer this, and we should. No, you can transfer securities as they are. You don't have to sell and repurchase. It just boop, moves over at whatever value those securities were at the end of the day. They just simply, that value leaves your IRA, goes into your Roth IRA. You don't have to sell. You don't time the markets that way or anything like that. All right, so I see Dave Myers responding to a lot of people here. Good, thank you, Dave. Okay, Jackie as well responding. Susan responding to Brenda. Yeah, okay. So sorry, there's a huge list of comments here. I'm trying to scroll and see who addressed what already. Elizabeth Boardman asking about NUA. Ooh, timely. Just did a video on that. I'm not sure what you mean, Elizabeth, with regards to NUA as it relates to Roth conversions. There is no NUA concept in Roth conversions. NUA is only when the shares in your 401 get moved out to a regular brokerage. To my knowledge, there's nothing NUA related that comes into play with conversions. All right. Yep. So Richard just saying he did it in kind at Schwab and they let him pick the specific securities. Yep. TD is the same for clients I work with at TD. Marianne asking, does severance count as income? So could I contribute to a Roth IRA this year? Yeah, I think so. My answer is always you have to see how your employer is going to code it and consider it when you get your W-2. Will it show up as regular wages in the regular wage box? If so, then yes, severance would count as quote unquote earned income, which would make you eligible to contribute. But if they code it as something different, if it's just like some other kind of lump sum payout that's not considered earned income and there's not like FICA, payroll taxes paid on it, it may not. So I think you really have to ask your employer, Marianne, how they're going to consider it and how it's going to show up on your W-2. All right. Wow, definitely can't keep up here. Okay, let me do this. So final bit here I got prepared is 3 questions I get asked routinely. Let me answer or talk about these, and then I'll just go back to these questions and just answer however much I can about what you all posted. So thank you. All right, so most common questions I get about conversions is 3 things. One is how much money should I have in a Roth? And David Fultz, this goes back to your question originally. There's no right answer to this. Some of it's going to depend. Lots of educated guessing about the future. That's one of it, which makes it impossible to nail down a precise figure. It's also going to depend how much other taxable income you're going to have in the future. So, for example, if you and your spouse, let's say, are going to have relatively large pensions, that's all taxable income to start with. So let's say you each have a pension of $50,000. That right there is going to be $100,000 of taxable income you're never going to be able to shake or get rid of. Now, it's a good problem to have. I mean, I'll take a good pension any day of the year, any day of the week. But nonetheless, you're already at $100,000 of gross income with those pensions. Add Social Security to it. Maybe now you're at 150, 160, 170. That's a good chunk of income you're always going to have. So any additional tax deferred withdrawals or required minimum distributions you're going to have to add on top of that, you could be bumping yourself into a really high tax bracket in retirement. Again, not just tax bracket, but maybe these Medicare surcharges, more of your Social Security getting taxed, more of your passive investment income getting taxed. In that case, then you probably want to trend towards not having so much in tax deferred money and ideally trying to have, get some of that out into a Roth. How much is the right amount? I don't know. This is where it's impossible to say. I say it's good to have a quote unquote healthy mix across the across the different account types: tax deferred, Roth, and regular brokerage. What's healthy? shoot for like a third, a third, a third. Now, again, this is going to depend. If you have lots of pension and Social Security, you probably want to shoot for even less in tax deferred money. But for most people who probably don't have a pension, or if they do, it's not going to be huge, it's really just Social Security, then you may not have, you're not going to have massive amounts of income coming in every year as it is. So you'll have some room to pull out money from tax deferred accounts and not have it be taxed egregiously. In that case, it's not the end of the world to have a good chunk of your money in tax deferred. So not a great answer, I know, I apologize, but it's all facts and circumstances without running through your specific details and projections of what kind of income you're going to have, where your account balance is, and things like that. Also, what your legacy goals are. Again, if you plan on dying with a lot of money and you want to leave it to a charity or leave it to someone who's doesn't have a lot of income, it's not that bad of a thing to end up with a big pot of tax deferred money, because it's going to get used tax efficiently after you leave. On the other hand, with the legacy planning angle, is that if you think you're going to have a good amount of money left and it's all going to go to your kids, let's say, and your kids are in their peak earning years, in their 40s, 50s, they both, they have high paying jobs, they're paying a lot of tax to start with. It may not be ideal sticking them with another $1 million of IRA tax deferred money. Now, sounds like a good problem to have, and it is. I mean, any money, them getting money is better than not getting money at all, but them inheriting lots of tax deferred money isn't ideal because they're already paying a lot of tax, and them having to withdraw from your inherited IRA is going to be highly taxed. So if you, in your retirement years, are in a lower tax bracket than your children are, then maybe part of your legacy wealth transfer plan is that you bite the bullet and pay some of the taxes for them. So you do conversions while you're alive. You pay taxes at your relatively low tax rate so that you're leaving mostly Roth money as opposed to tax deferred money to your kids, because when people inherit Roth accounts, they don't have to pay tax on it. It all comes out tax free. Unlike regular tax deferred accounts, it's all taxable income to them when they pull it out. So point is, there's lots of moving parts, and everyone's answer is going to be a little different and unique about how much should I have in Roth versus tax deferred versus IRA. Just know that it's not the end of the world to have some money in tax deferred. How much is too much? Don't know. And getting back to Shauna's question earlier, what's the benefit of not doing conversions? If you have so much money, there's a negligible chance of you running out. Maybe you don't care. It's like, so what? I'm going to pay tax, whatever. I'm just thankful I have this money. I don't want to worry about it. Whatever taxes are, that whatever they're going to be, they're going to be. Just let it sit. If that's your mindset, fine. That's the right decision for you. I've talked to people who are vehemently opposed to having to pay taxes in the future, and are so gung-ho about converting as much as possible now. It's almost to the point they shoot off their nose to spite their face, just to get all their every single dollar out of tax deferred accounts, because they don't trust the government, they don't trust where taxes are going to go, or are otherwise concerned about how high taxes may be. So that person's answer is going to be very different than the other person who's like, I don't care, I just want to live happy, and wherever my money goes, it goes. All right, next sort of question: how much should I convert this year? I get that a lot. Hard to say. Again, it's all facts and circumstances. You need to sort of figure out what your taxes and your income may look like in the future, which is hard to say, but you got to at least put pen to paper and do some educated guessing and projecting. But I say, my rule of thumb, and different people feel differently about this, is if you're in a low enough tax year now that you can convert and have it be at 10% or the 12% bracket, that sounds awesome. The 22% bracket, still okay. That's where I start to lose conviction, but not the end of the world if you convert at 22, because that's going up to 25 in 20. The 22% bracket's going up to 25% in 2026 when Tax Cuts and Jobs Act expire, if not sooner. And I have to think tax rates are going to go up even further because of all the economic stimulus money that was created this year that has to attempt to get paid off somehow. So expect taxes to go up even more. Anyway, point is, converting at 10 and 12% now is good. 22%, still not bad. 24%, that's where I'm 50-50. If you're converting and it's at the 24% tax bracket, I'm like, it's your call. If you want to do it, great. I won't tell you not to, but I'm not going to sit here and say, yeah, definitely. Once you're over the 24% bracket, so you're in the, 32, 35, that's a hard nut to swallow. I can't make a compelling argument why someone should be converting today at 32%, unless for whatever reason they know they're going to have such a massive amount of money or income in the future that they're going to be in the 30+% tax bracket in retirement. Then it's a different story. But most retirees, unless you're ultra wealthy, I don't think you're going to be up into the 30% tax bracket. Not likely. Now, maybe if you're single, like there's something called the widow and widower tax penalty. I also have a video on that. If you're a married couple that has a lot of assets, a few $1,000,000 of assets, when one spouse dies, the surviving spouse is now considered a single tax filer, and that those single tax rates, tax brackets get compressed. So long story short, there could be some single person over $200,000 is where 32% tax bracket starts. So there is some consideration to give for married couples where if you have a lot of assets, if and when one of you dies, what's the tax situation going to look like for the survivor? That's another angle to plan for. But point is, being in the 30+% tax bracket in retirement isn't that common. So therefore, I'm hard pressed to say if you're in the 30+% tax bracket now, it doesn't feel right doing conversions then. But to each their own. I know people who do and are plenty happy with that decision, so I'm not going to tell you you're wrong. And finally, before I get to all your questions, or as many as I can, one other thing. I get this. I've had this conversation literally 3 or 4 times in the last 2 weeks with people coming back to like, how much should I convert this year, if any? If you are getting ACA tax credits and it's more, it's a few $1,000s a year or more, I'd struggle to say give that up. I'd struggle to say, yeah, do some conversions and lose that. A bird in the hand is worth 2 in the bush, especially if that bird in the hand is like 20 grand a year you're getting in these tax credits on your health insurance subsidies. I can't in good faith say, yes, give that up so you can convert money today. I'm still a fan of conversions in general, but in that case, you're giving up way too, in my opinion, I think you're giving up way too much if you're walking away from $10,000, $15,000, $20,000 a year of tax credits in doing conversions. So if you are getting ACA credits, I think conversions aren't probably the best thing for you. But again, I can't say with certainty because who knows what the future holds. All right, final question that I get a lot is, how do I pay taxes on conversions? As I mentioned before, when you do conversions, it's all taxable income in the year of the conversion, so plan accordingly. Ideally, it's best to pay the taxes with money that you have in your checking or brokerage account or something like that. Point is, not ideal to pay the taxes from the IRA. So for example, not the end of the world, but here's the example. So let's say you do a $50,000 conversion from your traditional IRA to your Roth IRA. And you say, withhold 10% of that to pay for federal tax. So of your $50,000 conversion, 5 of it goes straight to the IRS, or to the Treasury technically. Only $45,000 of it actually ends up in your IRA, in your Roth IRA, sorry. So you're going to be taxed on $50,000 of conversion, but you're only getting the benefit of 45 of it going into your Roth. Now, if that's your only option, so if you don't have the $5 grand of cash laying around in your checking account to pay the tax, so be it. Not that bad. Especially if you're over 59.5. If you're under 59.5, having tax withheld from your IRA upon the conversion, that tax withholding will be subject to the 10% early withdrawal penalty, because that withholding is considered a distribution. And if you're under 59.5, distributions have a 10% early withdrawal penalty. So definitely not ideal to pay for the tax in the conversion by way of withholding from your IRA if you're under 59.5. If you're over 59.5, not as bad. I'd still lean towards saying try to have cash outside of it to pay, so all $50,000 goes into your Roth IRA as opposed to some getting sliced off to pay taxes. But if that's your only option, sure, go for it. Or you can increase, if you are still working or have like a pension or Social Security where you can toy around with withholdings, you can increase your withholdings elsewhere. Instead of withholding from your IRA, you can maybe withhold some more money from your wages or from your Social Security check or something to boost up your withholdings to cover the extra tax you're going to owe for the conversion. All right, that's all the things I wanted to get through. So let me now, oof, man, yeah, massive list of questions. I'm liking it. All right, let me see what I can do. I don't know if I should start at the bottom or the top here because there are dozens of questions. Let me just start kind of where I left off. Douglas Schobel, does it make sense to do a traditional 401k now for FAFSA and lower AGI purposes and then convert when the kids are out of college? So FAFSA is the financial federal aid process. Oh, I just lost the question. Where'd that go? I guess there's only so many comments I can stay in my view here. That's definitely something to consider. I'm far from an expert in college planning, but yes, if you do conversions now, that'll increase your income, and your income counts against you for federal aid student loan purposes to some extent, but I am not an expert in that space. All right. Andrea Burke, I'm retired. I have a simple IRA, about $25,000. Can I convert this to my Roth? That's a good question. Can you convert simples? I think so. If no one else answered this, David Myers or Cody, if you're on here, can you convert simple IRAs to Roths? I think you can. I don't know that with certainty, though. Good question. Brenda, when do you pay tax on the conversion? So that I addressed. I mean, you can either increase withholdings elsewhere through wages or whatever, or pay estimated taxes in the quarter of the conversion. So like me, I did 2 conversions this quarter. I did them both in one November, one December. So this is the 4th quarter for tax purposes. And the 4th quarter estimated tax payment is due by January 15th. I did mine yesterday. I just wanted to get it out of the way. But you want to pay the tax. If you're not doing it through withholdings, Brenda, you want to pay the tax in the quarter of the conversion. All right. And we should. If I had post-tax money, will I still have to pay tax for Roth conversion? Isn't that paying tax twice? Yeah, sort of. That's definitely check out my video about backdoor Roth IRA. If your IRA is solely after-tax money and there's no pre-tax money, then no. When you convert that, you will not have to pay tax on it because you already pay tax on the way in. But if your IRA has a mix of pre- and post-tax money, there's going to be something called pro rata rule or proration. Every dollar you convert is going to be deemed to be prorated parts of pre- and post-tax money. So you're going to have to pay tax on the pre-tax part that's getting converted over, and we should. All right, so yeah, Dave Myers on fire with these comment replies. Thank you. So Mike Schellenberger, how bad is it to use part of the conversion to pay taxes? Yeah, that I already touched on. Brenda Polby, does conversion generate a tax form? Yeah, okay, good. Dave Meyer, 1099-R, yes. So anytime you take a distribution of any sort from an IRA, retirement account, it shows up on a 1099-R. Excellent. Cody hit on that too. Okay. June Lee, just seeing if anyone responded here. June Lee, conventional wisdom is to put the most aggressive investments in Roth and tap at last. Any reason to have stocks and bonds in Roth and tap earlier? Yes, that's conventional wisdom. June Lee, put the most aggressive things with the highest likelihood of growth in a Roth, so all that growth can eventually be tax-free and tap it later down the road. Any reason to have stocks and bonds? Well, the reason would be if your allocation is, let's say, your broader allocation is 50-50 stocks and bonds, and you don't have enough tax-deferred money to have your 50% bond allocation go there, you have to have some of your bonds flow into your Roth, sure. But I would generally say try to keep your Roth to stocks. I mean, I guess the exception is if your withdrawal plan in retirement is to tap your Roth to give yourself some income without tax, then maybe yes, then maybe you do want something a little conservative in your Roth so that you can sell those assets. So for example, if you have a distribution plan in retirement where you're going to pull out 60 grand a year from tax deferred just to fill up some of your lower tax brackets with 60 grand and then pull any additional income you need from your Roth that won't be taxable, and so you plan on having to make Roth withdrawals multiple years in the next coming years, then yes, June, you would probably want some more conservative stuff in your Roth, so that if and when there's a bad stock market year, you're not forced to sell the stocks in your Roth. You can sell the bonds, which should hopefully be not at a really beaten up or depressed price. All right. um, Tony DiLorenzo, does the annual Roth limit, say $6,000, have any impact on a conversion, or can you do a conversion and contribute the max? Sort of. So, and this gets back to, I forget who asked the question, but about making, and I didn't think to say it then, about making a deductible contribution to a regular IRA and also doing a conversion. Yes, you can do both. So, for example, Tony, you can do, if you're under 50, you can do the full year $6,000 contribution to a Roth, assuming you're within the income limits, and also do a Roth conversion. Now, keep in mind the conversion will increase your income. So, if you convert so much that you bump yourself out of the eligibility to make a Roth contribution, then no, you can't do both. But if you manage your income right, under about 200 grand if you're married, yes, you can do your $6,000 Roth contribution and you can do conversion on top of it. But again, remember, conversions add to your income, and too much income may knock you out of eligibility to make to do the contribution. Tony, good question. Pam Stotts, can you take money from an annuity and move it to a Roth? Depends, possibly. Annuity can mean lots of things. There are types of annuities where, like deferred annuities, where it's sitting in an IRA, it's invested in stuff. It's not yet annuitized, meaning you still have the ability to take the money out, transfer it, roll it, whatever. You may have a surrender charge, depending on the annuity and how long you've been in it. But let's assume you're outside of the surrender period, Pam, and you're not penalized for taking money out of your annuity, then yes, then I believe, so long as it's in a traditional IRA, yes, you should be able to convert it from the annuity to a Roth. Now, I haven't ever tried this, but maybe you might need to first roll the annuity into just a regular IRA, get it out of the annuity wrapper, just plop it in cash or whatever, and then convert it. I don't know if you can convert directly from an annuity inside an IRA to a Roth, but in theory, you should be able to get there somehow. Now, separate story is if you annuitize the annuity, meaning you irrevocably gave your lump sum of money to the insurance company and they're paying you a monthly payment for the rest of your life. In that case, no, you have no access to that money other than getting the monthly payments the rest of your life. You can't undo that and take like the cash value of it and convert it to a Roth, Pam. Right, so Dave replied to Brooke about you cannot do conversions of inherited IRAs, but you can for inherited 401ks. Go figure. What else we got here? Ileana, 1/3 each. So yeah, so I said super rough estimate. Not a bad idea to try to target 1/3 of your nest egg in regular brokerage, 1/3 in tax deferred, 1/3 in Roth. Again, don't get hung up on a third. It's just me picking some random numbers. Maybe the right answer is 20%, 40%, 40%. It's all going to depend on lots of things. But how does an HSA factor in? That's a great point. So most people don't have massive amounts of monies in their HSA because not many people have had an HSA for decades. And even if they did, the contribution limits are historically only a few $1,000s a year. But if you do have sizable amounts in your HSA, then I would consider that Roth money generally. And I say that because assuming you use it for qualified medical expenses, the money's all tax-free. Gross tax-free, comes out tax-free. In that sense, it's Roth-like. Where it's different from a Roth is that mainly upon when you die, if you don't spend all your HSA and someone inherits it, unless it's your spouse who inherits it, if anyone else inherits that HSA, Ileana, it's all treated like a regular tax-deferred IRA. All that income is fully taxable to whoever inherits it in the year they inherit it. Again, spouse is a difference. Your spouse can keep the HSA and use it like an HSA. Anyone else has to pay tax on it. So, but yeah, generally consider an HSA like a Roth in that third thing. Jay Nadler, is there an age where conversions are no longer allowed? No, there's no limit. You can be 130 and still do a conversion, Jay. All right, Doug Yachty talking about yeah, the widower tax penalty thing. While you tax plan as a married couple, reminder that at some point in the future you might file as a single person, meaning one spouse dies, with half of the standard deduction and half the income tax brackets, thus doubling your taxes. Exactly. Just an FYI and planning for the future. How much should you have in Roth versus traditional? Right. I touched on that before. When one spouse dies, taxes inevitably go up for the surviving spouse. So that could factor into how much tax deferred money do you want to leave versus how much Roth money. It gets complicated, which is why I said there's no single or easy answer to how much should you convert. But yeah, the widower tax penalty is something to consider as well. And I have a video on that on the YouTube channel for those who are interested. If my kids want more Roth, I will convert, but they pay taxes. Oh, right on. Have them gift you the money for you to pay the taxes, June. Yeah, nothing wrong with that. Doug Yachty, max the 22% bracket up to the IRMA. Yeah. Brenda Pulvey asks what income limit on 22%. So Brenda, for 2020, if you're married, the 22% income 22% bracket stops at $171,050, but that's taxable income. So add to that your standard deduction, let's say, which is 25 grand about, and we're at call it $196,000. So Brenda, if you're married, you can have roughly $196,000 of gross income and be at the top of the 22% tax bracket. If you're single, inclusive of standard deduction, you are at about just shy of $100,000 of gross income is the top of the 22% tax bracket, Brenda. And for those of you who haven't seen, so Cody Garrett, frequent contributor, adds massive amounts of value to this group, and he and Dave Myers are here, chiming in all the time, thankfully. Cody he has a great blog, measuretwicemoney.com. He has a great article that I paste all the time in the group when people ask, should I do Roth or should I do traditional? The article's all about the things to consider, Roth or traditional, pros and cons of each and things like that. So, Cody, feel free to blast that link to that article up here. Or again, for anyone who's interested, measuretwicemoney.com. Lots of pieces of gold that Cody wrote on that blog about all sorts of things, not just retirement planning. All right, so Dave Myers checked out. This comment's 15 minutes old. Wow, that's how behind I am. Thanks a lot, Dave, for all of your support here. Much appreciated on behalf of everyone. Susan Nixon Blake. So the optimal time to convert after retirement, but before Social Security's pensions. Yes, ideally. So during this time, I'm guessing you're living off savings brokerage accounts. Yes. Plus, you need to have the cash to pay taxes on the conversion. Yes. Plus, you should have a couple of years of expenses in cash to avoid sequence of return. Yes. This makes my head spin. LOL. Seems like you need to have a lot of cash at the time. Yeah, that's yes. To do massive amounts of conversions in those years, yes, you would need lots of cash or brokerage assets or something. You don't have to necessarily do just conversions in those low tax years. You can also pull some money out of your tax deferred accounts just simply to live on. So again, married couple, 12% tax bracket, stop, inclusive of standard deduction, you can have about 105 grand of gross income. So for example, you can maybe pull out, let's say, $55,000 from your tax deferred account just to live on, pay for food and car bills or whatever, and pull out another 50 grand, well, not pull out, but do 50 grand in conversion. So now your gross withdrawals from your tax deferred accounts only 105 grand, all of which will be 12% only. So you don't necessarily need to convert the full amount if you don't have the cash to pay for it. But the important thing is getting ahead of this big tax deferred bucket you got where you're gonna have to pay taxes eventually. The more tax you can pay on that in your low income years, the better. Whether it's conversions or simply taking withdrawals to live on or a combination of the two, do not let your 10 and 12% tax bracket go to waste when you're in those early retirement years. It's a shame to not fill those up, whether it's conversions or just living on money from your tax deferred accounts. But that's the sweet spot in years to take advantage Dan Trainer, for some people, depending upon their goals and specific situation, it may not actually make sense to do Roth conversions. Correct? 100% correct, Dan. So I'm guilty of talking about conversions all the time and making them sound like they're great, and they are for the right people in the right set of circumstances. But no, not everyone should do conversions. Not everyone has to. Not everyone wants to. Not everyone will get tremendous amounts of long-term value from them. Again, everyone's situation is different, so I can't say they're always good, they're always bad, but you're 100% right, Dan. Like everything in financial planning, not everything makes sense for everybody. Or if it does, maybe it's only in limited amounts or circumstances. So I don't want to say I feel guilty, but I think a group like this that constantly, I don't want to say preach, but constantly talks about the benefits of Roth conversions, I think some people might feel like, ooh, I got to do that. Everyone's talking about it, I got to do it. No, not necessarily, right? And to Dan's point, they're not right for everyone. They're not the best answer for everyone. So apologies for all the pro Roth talk we do in this group. I try not to be biased about it. I'm just giving education and speaking where I think it makes sense. But don't feel left out if you've done the math and you're like, I don't get it. I don't think Roth conversions are going to help me. You could be 100% right. So no, it's not like everyone needs to do or should be doing Roth conversions. Great point, Dan. Okay, so Cody's replying to Andrea about the simple IRA. You can roll the simple IRA to a traditional, then convert to a Roth. Okay, so yeah, maybe based on what Cody's saying, maybe you can't directly convert from a simple to a Roth. And also with simple, it's a good point, Cody. You need to have it open for at least 2 years before you can do any of that stuff. That's right. All right, what else we got? Yeah, Ira Rosenberg, convert a major portion of total planned conversions at the beginning of the year and leave some for the end of the year when your total tax picture is clear. Yeah, right, exactly. So when you used to be able to undo conversions a few years ago, that didn't matter. You can convert a boatload in the beginning of the year and just whittle it down at the end. You can't whittle it down. Now it's a one-way road only. Once you convert, you can't take it back. So yes, I think ideally have an idea in your head of how much you want to try to convert, but that presupposes you have a good idea what the rest of your income is going to look like. If your income's highly variable, then all bets are off. But if your income's fairly stable, whether it's from wages, more or less what that's going to be. If it's pension, Social Security, you know those to the penny. Capital gains and losses, you have some control over because you control when you sell things. If you have a good idea what your income's going to be, you can back into roughly how much you're going to convert. Then I think never try to market time, but if there is a big sell-off in the market, get some conversions in then. Again, more bang for your buck, but don't overdo it. Wait till the end of the year when you know with certainty, or much more certainty at least, what your income picture looks like. That's when you kind of fill in the rest. That's why I did my conversions in December, because my income in my new financial planning business here was high. I had no idea it was going to be in the beginning of the year. So now that we're at the end of the year, I have a pretty good picture what I know what I made this year. So that's why I did my conversions in the last month or two. Yeah, Steve or Steph Suter. Still time to convert to Roth, but don't wait till December 30. Yeah, good point. So I said it twice, I'll say it a third time. Super important. Do not wait till the last couple of days of the year to call up your custodian and ask them to convert. As I mentioned, TD said you have to get it in by December 21st if you want to guarantee that they'll be able to process it this calendar year. I assume most other custodians will be the same. That means there's 3 business days left. 2 business days. Thursday, Friday, and maybe Monday. Anyway, point is, if you want to do a conversion this year, get it in the next few days. If not, don't bank on it getting done this year, unfortunately. Moving along, getting there. Let's see. Lengthy one here from Jay Nadler. Let's see what I can do here. I have both a Roth annuity and a cash annuity with Prudential for the last 10 years. I called them today and asked tax implications concerning the cash annuity. And during my discussion, the rep told me there'll be taxes in the Roth annuity for any amount over the original investment. That doesn't seem correct as it defeats the purpose if a Roth. Question mark. Yeah, it's a good one. I've never actually seen an annuity inside a Roth IRA, Jay. Not to say it can't be done. I've never thought about this before. In theory, it sounds wrong that any growth would be taxed, but I don't know. Annuities are always odd animals when it comes to taxation. So maybe I don't know. I'm just making this up. They could possibly be right. Maybe once you put an IRA inside once you put an annuity inside a Roth, perhaps there is taxation on the amount above and beyond your initial contribution. I don't know, but with annuities, nothing surprises me. So I don't know the answer to that. I would like to think it's not the case, Jay, but I don't know. All right. Okay. Looks like we're getting towards the bottom here. Not bad, not bad. Yeah, so Cody, there's his Roth versus tax deferred. Awesome, thank you. Okay. June, Ed Slott, convert the heck out of it. Yeah, Ed Slott. So he's probably one of the preeminent experts in IRAs and taxation and Roth IRAs, and he's all in on Roth conversions. Again, he doesn't give specific advice to anyone, but you read any of his stuff. Ed Slott, S-L-O-T-T. You can look him up. He's a real big fan of conversions for the reasons we mentioned today. Super low, generationally low federal tax rates now. We know they're going up. They'll probably go up even further. So he likes it for those reasons. Chris Fultz, do you keep your jokes in a database? Oh, wow, man. Yeah, I see what you did there. That's a good one. Well played, Chris. No, I don't. I probably should create a database. That would be good. All right. Okay, looks like we're winding down here. Just people saying comments about the presentation. Thank you. Thank you all for the kind words here. I think convert some tax. Good. Vanguard Wellington is announcing a big cap gain December 30th. Annoying. Yeah, that's the problem with mutual funds. When you hold them in a regular brokerage account, you get stuffed with unknown amount of capital gains at the end of the year that you have no control over. I mean, getting gains is good. It means you made money, but it also could mess up your tax planning somewhat. Okay, that's it for the comments / questions for what I see. Thank you all for hanging around this long. We are 20 minutes after the normal hour that we run with these things. So that's that. It was great end to 2020 with these things. Thank you all for tagging along with me each Wednesday night or Wednesday afternoon, depending wherever you are in the country. I definitely appreciate it. I appreciate all the comments and support that you all give, not just in these weekly lives, but in the group. The group has far exceeded my expectations in terms of number of members and quality and quantity of contributions from everyone. So thank you. The engagement from you all is what makes it what it is. So I'm appreciative of all of you. With that said, I'll still see you in the group in the next couple of weeks, but I'm done with the lives until January 6th. So until then, happy holidays, stay safe, and I will see you all in 2021. Take care. Where's my end button?